Hi, it's Mike Power with Silver Range. Here's a look at where we think the junior gold mining exploration business is at and where it's heading. First, quick word from our lawyers. Please do not rely on anything in this presentation as investment advice. All right, let's take a look at what's going on. We'll look at a few things. First, the divergence between the gold price and the underlying equities. We'll have a look at financings, our best indicator of the current state of the market. Have a look at option activity as a proxy for what people in the know think might be happening next. And finally, we'll take a personal look ahead. The venture's long been used as a proxy for the health of junior mining exploration. Here's the venture since 2015. You can see the sharp upturn in 2016, which I remember well, the downturn for COVID with a sharp rebound. And since then, there's been a continual gradual decline in the venture and in the overall health of the junior mining exploration business. We love the Canadian Securities Exchange. We think it's the best place to list anywhere. And it's heavily weighted to junior mining stocks. Here's the CSE composite since 2020. And once again, it mirrors that pattern in the venture. There was a downturn associated with COVID, a sharp rebound, and since then, a continual decline. So all in all, investors are not much interested in the junior mining exploration game. Turning more particularly to gold, the Van Eck GDXJ is a ETF composed of junior gold miners and explorers. It's widely followed as a sort of proxy for the health of the junior gold mining exploration industry. And here's GDXJ since 2017. You can see the COVID downturn, the rebound, and a general decline in the GDXJ since then. Perhaps it's terminated last April. There's a rebound which appears to be gaining some strength, which suggests that maybe the overall downtrend has been broken. Let's take a little closer look at GDXJ. This is integrated money flow. Think of it as the amount of money residing in the GDXJ. And we're looking at the past couple of years. You can see that in general, there's an overall declining trend with a few spikes, most notably this April when the gold price had turned up and was widely recognized by the market. But that quickly subsided. And instead, what we have is an overall decreasing trend in the amount of money being invested into junior gold mining and exploration stocks. And that's occurred in spite of a remarkable divergence between the price of gold and the price of the underlying equities here proxied by GDXJ. Starting in about 2022, shortly after the Ukraine invasion, central banks around the world began buying gold. This was in reaction to moves by America and the European Union to freeze Russian assets. Some central banks, less than entirely friendly with the United States, decided it would be wise to diversify out of treasuries and start buying gold. Notable among them was China, Russia, and countries in the Middle East. In addition, in supporting this trend, there's been a lot of gold purchases by the private sector, particularly in China, where there aren't a lot of other investment opportunities. People have been buying gold down to the size of small beans. So with this twofold demand has led to an increase in the price of physical gold and an increased demand for physical gold. And this has largely shut out the gold ETFs or paper gold creations on Wall Street, and they've lost a bit of control of the market. Now, in spite of this strong gold price, the GDXJ has languished, and there's a divergence between the two, which we believe creates a significant investment opportunity. Inevitably, there will be a reversion to the mean. Well, let's turn to financings. In the exploration business, money is oxygen. Without money, we can't run exploration programs, do options or deals, or buy each other. And this money is coming from speculative investment. And this is very difficult to track. You can get fragmented views by looking at returns from individual exchanges, but really the only way to put it all together is you have to look at all of the reports of exempt distributions that are filed with CDAR. That gives you a picture of what's actually flowing into the mineral exploration sector in terms of money being received by the companies. We've tracked that, and we'll show you what we see in this data. Let's start with total financings raised. We're looking at 6-week trailing moving average data here. The moving average is necessary because the data can be quite choppy, and it's got to be a trailing moving average because we use this for predictive purposes. You can see that July 2023 was a terrible drought in financings raised. It rebounded a little bit. This notable peak occurred at the end of May, beginning of June, and is dominated by 4 financings. That's Cameco, Taseko, NextGen, and Equinox, each raised between $350 and $600 million, and that totally distorts the picture here. And that's a general feature of mine financings. If you're trying to analyze what's going on, the aggregate totals can be very misleading because they're dominated by just a few raises. Let's break down all of these financings by size. In purple are the very large financings. You can see how they dominate all the money being raised. The smaller financings are just a tiny fraction of the big money being raised, greater than $2 million. If we look at the number of financings binned by the size of the financing, we see that last July was a real nadir with only 40-odd financings completed, and that's returned to a much improved level of around 80 to 100, still low. The interesting thing to note in this is the proportion of the very small financings, those are the ones in red and orange, has increased dramatically over this period. And that's an indication of a sick market. In analyzing this data, it's very important to ignore the very large financings and the aggregate financings, which are dominated by them, and instead look at the smaller financings. That's where you're going to get indications of market health. This data, kindly provided by John Kaiser, shows TSX venture financings back to 2000. And what we're looking at here is the proportion of financings binned by size, with the smaller financings in red at the bottom and the very large financings in blue and violet at the top. Superimposed on this are periods of market contraction and doldrums when the junior market was in what John calls periods of nuclear winter. The interesting feature about this is that going into every one of these downturns, there's a dramatic increase in the number of small financings as a proportion of the total. Here I've highlighted financings less than 200,000. That's the red and orange. You can see there's an obvious base level to this curve. That reflects inflation. 200,000 would buy a whole lot more exploration back in 2000 than it does now. You can also see that going into every one of these periods of market downturn, there's a sharp increase in the number of financings less than 200,000, and in many cases, a very sharp decrease in the number of those financings when the market recovers. I would suggest to you that if the proportion of financings less than 200,000 is in the range of 20-25%, that's a pretty good indicator that the market is not in a healthy state. Okay, here's our data, and this is not just the venture, but CSE and all reporting issuers in Canada. And you can see that the proportion of very small financings was less than 10% last July when this downturn started, and now its increase is closer to 20%. You can also see that the very large financings are being squeezed out at the top. This overall picture is not an indicator of a healthy market. It would suggest that the downturn is continuing, and we don't see an end in sight. There is some good news, however. If we look at financing less than 2 million, and I would posit these are the sorts of financings you need to keep a company running and run a drill program or do an exploration project, you need financings in the order of 2 million, maybe a bit less. Okay, what do you see here? You see that the number of these smaller financings has finally improved from the less than 40 last July. Now we're up to a healthier level of closer to 80. But nonetheless, there's a very large proportion of very small financings, the 100,000 or less, and 200,000 to 100,000 in the red and orange. So this is a picture of a market that's still in distress. trying to work out some problems, but they don't see a sign of a big rebound here. Okay, let's have a look at what the promoters are up to. The best indication of what promoters are interested in is what they're willing to option. So let's have a quick look at recent option activity. Here's mineral property options for the past couple of years, color-coded by target type. You can see that there was an overall rising trend, which peaked in March 2023, and thereafter an overall declining trend, which continues to this day. The anomalous spike in May 24 may in part be a compensation for a very depressed April. I think that data point can be ignored. But in general, you can see that after March 23, it's been a pretty much steady decline since then. And that also reflects the broader market and financing conditions, because the financing drought really took hold in May of 23, and I think this is reflected in the option activity. If we look at the proportion of properties being optioned by different target types, we see a continuation of a pattern we noted this spring, where uranium is becoming an increasingly popular commodity at the expense of battery and critical metals. That would include lithium. They're definitely on the decline. There's steady demand for base metal projects shown in purple, and there's always an underlying demand for gold projects, which seems to be increasing since June of 23. To close off, here's our view of what might be ahead for the junior gold miners in the next few months. First off, we see a broad market correction likely this fall. Gold prices, however, we believe will remain quite strong, buoyed by central bank buying, uncertainty with the US dollar, geopolitical risk, and a general reversion to mean with respect to the proportion of financial assets people hold in gold. In America, for example, they used to hold about 2% of their assets in gold. Now it's about 0.5%. We think in these uncertain times, people will be adding more gold to their financial portfolios. For all these reasons, we think the gold price is going to remain strong. And the major gold producers are going to shine. They're going to show greatly improved results. However, their AISC, all-in sustaining costs, are going to rise, largely because they're going to switch to maximizing production at the expense of margin. I think they're going to start taking in a lot of lower grade material on the edge of pits, maybe opening up some marginal deposits that they had mothballed, and as a result, we'll see no fat dividends. However, intermediate producers, the 1 and 2 mine companies, I think will really shine. They'll show tremendous profits over margin, and they're going to be quite attractive as M&A targets as the cycle picks up. The majors will have cash to buy resources. They'll take out these intermediate producers, and that will finally cause money to flow back into the junior gold explorers as we seek to replace all these resources that are being fed up the food chain. If you want to guess on timing, I think things will feel a lot better by PDAC or March next year. Well, what's this mean for Silver Range? We see tough times ahead, likely into the new year. And in the interim, we've been cutting fat and we're looking for more. We're going to run some fall exploration programs, but they'll be very much focused on advancing our most promising prospects. We'll continue to work the phones and try and sell into this very poor market, but we believe these efforts will bear fruit as soon as the market turns around. And finally, we're continuing with a lot of project generation, developing some new targets to stake as soon as the market is ready for them. So that's it. We see better days ahead, and we're working hard to prepare for them. They may not come quite as quickly as we hope, but we're going to stick with it. We hope you'll ride with us too. So long.